Hello everyone, thank you for watching. Before we dive into our presentation, let's warm up with a little tax brain teaser about Bill. Sounds like fun, right? So, after working hard for his adult life, Bill, age 65, has finally retired and he's going to more concerts than ever before. Bill has $48,908 in taxable income, which includes $37,500 of Social Security benefits this year. As you can see, Bill's $48,908 of taxable income puts him in the 22% tax bracket because it's more than $47,151 and less than $100,525. Toward the end of the year, Bill decides to take an extra $1,000 out of his IRA for a trip to see Willie Nelson play in Austin. How much is he taxed on that extra $1,000? The logical answer is that for every dollar of IRA money he pulls out, he pays 22% in federal income taxes. Therefore, if he took out $1,000, he should owe $220 in federal income tax, 22% tax. Simple enough, right? Wrong. He owes $407 in tax, a 40.7% federal tax rate on that income. Thanks to the madness that is our tax code and the unique formula that determines how your Social Security benefits are taxed, the real answer is that Bill owes $407 on that extra income. Welcome to our webinar series, How Tax Planning Changes Through 4 Stages of Retirement. My name is Chris Foster and I'm a financial advisor with Full Cup Financial. I thank you for watching to learn more about taxes in retirement. And I want to assure you of one thing about this presentation. I believe you'll be better informed about the challenges of retirement tax planning after watching. Now, you may be wondering, why is a financial advisor giving a presentation about retirement tax planning? From time to time, I present workshops and classes on various financial education topics such as Social Security, retirement planning, IRA planning, healthcare planning, cybersecurity, and late-stage college planning, among others. My goal is always to inform and educate so you can understand how critical financial planning topics affect you and your family. I do this presentation because I've seen many people make mistakes and pay more taxes in retirement than is necessary. When that happens, it makes my job harder because people have less income in retirement and we have to find ways to make their portfolios last. Taxes can seem complex and jargon-filled, even though the underlying concepts are fairly straightforward. So let me take a second to explain how this webinar will unfold. The presentation is organized into 4 keys. Each key builds on the previous one to form a solution to our presentation problem, as you'll see. But now, there is one other important point I need to make. Everyone's tax situation is different. You should always consult a qualified professional tax advisor to discuss your specific tax situation, especially about these topics. Traditional IRAs, tax deferred, you must pay taxes on distributions or conversions at ordinary federal and state rates. Roth IRA, non-deductible, money grows tax-free, and earnings may be withdrawn tax-free in accordance with IRS rules. State taxes. This presentation references federal taxes. You may still face state taxes. Check with your tax professional. I'm a financial advisor and I do not provide tax advice. What I do is help people understand how the tax code and other rules could impact their financial planning and investments. And then we develop a plan to take into account many of the odd things people encounter, especially around taxes in retirement. Our goal here is to help you understand that the retirement distribution game, spending assets in retirement, is much different than the accumulation game when you're saving for retirement. Chances are you have been in the accumulation phase of your life for several decades, and you've been working hard and trying to save money, and hopefully your accounts have grown. But now, as you enter or prepare for retirement, you're in an entirely different phase, the distribution phase. And the distribution phase has new, strange rules that can catch people off guard. And along with those new rules, there are often many changes in your own personal life that can have a big impact on your taxes too. For instance, your children are grown, and that means no more child tax credits. Your house may be fully paid off, and that means no more mortgage interest deduction. If you've already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you've stopped working, you may no longer have the ability to stash income in a 401k or similar plan to manage your annual tax bill. At some point, you'll start taking Social Security, and sooner or later, when you reach 73, you'll have to start taking required distributions from your retirement accounts. The list of changes goes on. Many aspects of retirement will affect your tax bill in ways totally different from your working years. Understanding what these are and how they can impact you is absolutely crucial. So that brings us to a simple statement about the problem we're here to discuss. Simply put, people often pay more taxes in retirement than expected because a confusing system treats various income types differently and contains hidden taxes and penalties. In the accumulation phase, people build their assets in several different forms: stocks, bonds, real estate, pensions, 401ks, IRAs, and more. In the distribution phase, your regular wages stop coming in. You have to take the money you've saved and use it to fund your retirement, which can go on for decades with good health on your side. That's challenging because you'll need to make informed decisions about the tax implications of tapping different accounts, and it can be costly. In retirement, your tax rate can vary dramatically based on decisions you make, such as the timing and order in which you use different sources of money to pay for your expenses. Poor choices through misunderstandings or ignorance of the rules can result in people paying more taxes than necessary. As a result, they may see their savings drop faster, and that can mean less to leave to the kids and the grandkids. Of course, we don't want that to be you, and the fact that you are here means to me that you are willing to work towards a solution, which is an important first step. Because your tax exposure will change throughout 4 stages of retirement, you'll need a strategy that anticipates both traditional taxes and possible taxes, surcharges, and penalties related to Social Security, Medicare, and other income sources. That means you'll need an informed and proactive plan that addresses how you create your income in retirement. My goal is to introduce you to the major aspects of such a strategy and show you the challenges we all face, and then explain what makes up a workable solution to our retirement tax problem. The first step is to develop an understanding of the types of taxes you may face. What do I mean by taxes? I'm talking about all the costs that can increase as your income does, including some that aren't actually called a tax. To me, if your cost goes up as your income rises, it's a tax in my book. You also need to understand the retirement expenses you'll face, and you'll need to create a strategy that will help you decide which of your assets to tap first, how much you should be taking from those assets, and when those distributions should occur. Getting this right will help you pay as low a tax rate as possible. Before we go on, here are our 4 stages of retirement we'll discuss. These are rough ranges and descriptions. Your experience may differ. This is just a framework for discussing our topic. First, there's pre-retirement, the final work and save years of 50 to 60. Next, the early years of retirement, 60 to 70, the go-go years. People often have grand plans for this time, like traveling, volunteering, starting new hobbies, working part-time, and spending more time with family. Next, you reach the middle years of retirement, 70 to 80, the go-slow years, which bring more financial decisions, such as how to deal with required minimum distributions from your IRAs and other retirement accounts. Finally, there's the later years of retirement, when your health may not be as good and you're thinking about your legacy and estate. The no-go years, starting around age 80. As you will see, there are a wide range of issues that must be planned for in each phase, and this can be a lot harder than it seems, because retirement is full of surprises, and even the best planning will divert from reality at some point. One future unknown is inflation. People tend to view their future costs in current dollars and don't always anticipate how those costs grow with inflation. Think back 30 years ago to the cost of a gallon of milk, or a gallon of gas, or a visit to the emergency room. Now think about those costs today and what they'll grow to over the next 30 years when you're not working. That's inflation. Or how about your longevity? Many people end up living far longer than expected, and that requires more money at a time when it's difficult to work. How long do you think you will live? Many people also underestimate how much money they need to maintain a pre-retirement standard of living. And who wants to see their standard of living drop? And then there are healthcare costs, the 10,000-pound gorilla. That includes your out-of-pocket payments for services and drugs, plus Medicare and insurance costs, which keep rising. Now at this point, you may be thinking, okay, so what's the first thing I need to understand about retirement and taxes? Well, here it is, our first key. You have to know what your after-tax retirement savings picture looks like before you actually retire. Because a $500,000 401k or IRA balance isn't really $500,000. The government has a claim on part of that money because the taxes were deferred. They'll get their share when you're forced to start your required minimum distributions. The Secure Act 2.0 has pushed back RMDs to 73 if you were born between 1951 and 1959. If you were born after that, you won't have to start taking RMDs until you turn 75. Obviously, the higher your tax rate in retirement, the less your account is actually worth. Here's an example. This chart shows you the cumulative after-tax value of a $500,000 IRA earning 6% per year at various tax rates. And as you can see, the lower your tax rate, the more you keep. Simple in theory, difficult in practice. And by the way, of course, this presentation applies to both pre-retirees and retirees, so don't worry if you've already started your retirement. Tax planning is important throughout your retirement. Now you may be thinking, okay, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay my health costs. But one thing you need to understand when creating your retirement tax strategy is Social Security and Medicare have their own tax traps that you need to plan for as well. Let's go back to Bill from our tax brain tease. We want to understand why he paid such a high tax rate on the extra money he took from an IRA to go on a concert road trip. Remember, Bill has $40,000 of IRA income, part of his adjusted gross income of $65,538. And he has $37,500 of Social Security benefits. That puts him squarely in the 22% bracket, and he takes the standard deduction. Yet, when he took that extra $1,000 IRA distribution, he got hit with a nearly 41% marginal tax rate, $407 on that $1,000. Let's break down how this actually happens. First, let's remember the only difference between our two scenarios here is that Bill has taken an additional $1,000 from an IRA. You see that in after concert trip column, he has $41,000 in IRA income. So we see here that by adding that additional $1,000 of actual income, it increased both his AGI and his taxable income by $1,850. That means for every dollar of income he actually received, he's being taxed on $1.85. Huh? How? Here's the deal. Depending upon how much other income you have, the amount of your Social Security benefits that are taxable varies. For instance, if your other income is low enough, all of your Social Security benefits will be income tax-free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. Bill finds himself in the latter scenario. At his current income after the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he must also add an additional 85 cents of taxable Social Security benefits. And if you add that up, that's $1.85 taxable at his 22% rate for every $1 of additional IRA income he actually receives. If you do the math on that, it comes out to a 40.7% real tax rate on the additional $1,000 of income. That's the so-called Social Security tax torpedo. It can impact single filers and married couples with even fairly modest income during any stage of retirement. It's one reason planning taxes in retirement is important. Let's look at another aspect of Social Security and taxation and how people approach retirement. Now, during the go-go years stage, some people retire altogether, but other people enter into a sort of semi-retirement. Sometimes, it's a continuation of a previous job, just with fewer hours. Others use semi-retirement to explore an interest in a new field. Still others use semi-retirement to pursue non-paid, rewarding volunteer work. So working in retirement can impact your planning and taxes in a number of ways. Some good, some bad, and some downright ugly. Let's look at how working during these years can be a good thing. Chances are you have researched what your Social Security benefit might be at various ages, but you may not know that your Social Security benefit is calculated using your highest 35 years of inflation-adjusted earnings. Well, what if you started working late in life? Or what if you left work to raise children? You may not have 35 years of earnings history. Suppose you have only 28. The remaining 7 years count as big fat zeros when they calculate your benefits. But there's good news. Earnings at any age can help you increase your Social Security benefit. And thanks to how Social Security calculates benefits, replacing several years of zeros with even modest earnings can positively impact your benefits. Now let's look at how working during your go-go years can be somewhat bad if you're already collecting benefits and unaware of the Social Security earnings limit that applies prior to reaching your full retirement age. Here's how the rule works. If you start Social Security, be it your own retirement benefit or spousal benefits, prior to the year you reach your full retirement age, for every $2 above a certain amount that you earn, $22,320 in 2024, Social Security will withhold $1 of benefits. Keep in mind that we're talking about earnings here, like a W-2 salary or self-employment income, not pensions, interest, dividends, and capital gains. They don't count and won't reduce early Social Security benefits. For instance, let's say that you earn $24,320 in 2024. That's $2,000 over the limit. Therefore, under the $1 withheld for $2 earnings rule, Social Security would withhold $1,000 of your 2024 benefits, but these benefits are not truly lost. When you turn full retirement age, your benefit will be adjusted to make it as if you had applied at full retirement age with respect to those withheld benefits. In other words, your benefit going forward will be a bit higher. Also, in the year you reach full retirement age, there's a separate higher earnings limit. Okay, we've talked about the good and the bad, so now you get the ugly. We're here today to talk about taxes and retirement, but there are other taxes that you may face too. For instance, while you're working, you're subject to the 7.65% Social Security and Medicare taxes, in addition to income tax. The self-employed pay twice that amount, 15.3%, to cover the employer's contribution. Now, these taxes don't go away if you're working past your full retirement age, or even if you're collecting Social Security. Worse, if your go-go year's earnings don't make it into your top 35 years, those Social Security taxes go into the trust fund and don't increase your benefit. Now let's take a look at how Medicare and something it calls IRMA can impact some couples in the go-go years and beyond. First, what is IRMA? It stands for Income-Related Monthly Adjustment Amount. The emphasis is on income because it is a monthly tiered surcharge, again, a kind of tax, that is tacked on to people's Medicare Parts B and D premiums. But it only happens if you have income over $103,000 for single filers and $206,000 for married couples filing a joint return. Let's take a look at what this means in action. Meet George and Martha. They are a high-earning married couple, and both are Medicare Part B and D participants. IRMA surcharges affect income from 2 years prior, and this couple was on track for $322,000 of Modified Adjusted Gross Income, or MAGI, in 2022. But on December 1st, 2022, George decided to sell a stock he bought for $10,000 on July 1st, 2007. He sold the stock for $11,000. The resulting $1,000 of gain was taxed at the 15% long-term capital gains rate, plus an additional 3.8% net investment income surtax for a total federal tax bill of 18.8%. That 3.8% net investment income surtax is another tax that comes into play when your MAGI exceeds $200,000 for singles and $250,000 for married couples. So, George and Martha owe $188 of tax on the gain from their sale of the stock, right? 18.8% of $1,000. Or do they? Remember, my definition of a tax is any cost that increases as your income increases. So then, George and Martha will owe more tax than $188 because the gain from the sale of stock pushed them off the Medicare IRMA cliff into paying higher Medicare premiums. Let's take a look. Let's look at this Part B IRMA chart. That extra $1,000 gain pushed their AGI into the next premium tier that starts with $322,001. So now, instead of owing $349.40 each for their monthly Medicare Part B premiums, George and Martha will owe $454.20 per month, an extra $104.80 per month, times 2, $209.60, for an annual total in additional income-related monthly adjusted Medicare Part B premiums of $2,515.20. But it's not over, because Medicare Part D IRMA charges are also impacted. George and Martha will each owe another $20.50 per month for their drug plans, an extra $492 for the couple over the course of a year. Adding all the IRMA surcharges together for the year, George and Martha will each owe an extra $125.30 a month, or more than $3,000 of combined additional charges for the year. Now combine that amount with the $188 of actual federal income tax they would owe on their stock sale, and the total tax owed on the $1,000 of gain comes to $3,195.20. That's a tax rate of 319.5%. Let me repeat that. That's a tax rate of 319.5%. Let's do a quick review. They sold stock for a $1,000 income gain. The stock sale tax was $188, 15% for long-term capital gains, and 3.8% for the net investment income tax for high earners, for a 18.8% rate. The extra income from the stock sale triggers new IRMA tiers. The total IRMA surcharges for the year are $3,007.20 for George and Martha. So, the $1,000 extra income triggers taxes of $3,007.20, 319.5% real tax rate. You see, being pushed into a higher Medicare Part B and D premium range is worse than being pushed into a higher tax bracket. That's because if you go over a regular tax bracket by even a single dollar, only those last dollars are taxed at the highest rate. But if you go over the Medicare Part B and D income levels by even a single dollar, you move into the next premium tier. It doesn't matter if you exceed the limit by $1 or $10,000. That's what they call the IRMA cliff. Keep in mind, your IRMA payments aren't determined by how much money you made the previous year, but rather your MAGI from 2 years ago. It's another tax thing that catches people by surprise and needs planning. Making sure that you enroll in Medicare at the right time is a critical decision. If you bungle it, you'll get hit by a lifelong penalty. To help you understand, meet Jim and Ann, both 68. Jim retired at 65 and Ann retired at 66. Prior to her retirement, the couple had health insurance through Ann's employer, and they continued that after Ann retired because her employer offers retiree health benefits. Unfortunately, they didn't know that they had to enroll in Medicare Part B as soon as Ann retired. Even though Ann's employer offers retiree health insurance benefits, those benefits are generally paid secondary to Medicare after retirement. But Jim and Ann didn't realize the mistake until it was too late. And thanks to the way Medicare enrollment periods work, they weren't able to begin coverage until the next year. In a worst-case scenario, this might have resulted in a gap in coverage for Jim and Ann if they had a major medical need. But even in a best-case scenario, because Jim and Ann missed their deadline to sign up for Medicare Part B, they will each owe a 10% Medicare Part B base premium penalty for life. You can see how much that translates to in real dollars. They owe $420 extra in 2024. And historically, we can estimate that premiums will be higher, so that 10% penalty will grow and grow. Over the course of a lifetime, that could translate into a $10,000 mistake for the couple. For simplicity's sake, we're assuming that Ann's retiree health insurance covers prescription drugs, so they don't have to sign up for Part D. Just know there's a penalty for that too. We've seen how Social Security and Medicare have their own tax traps and unique rules and penalties. So if you're like some who've seen this presentation, you may be asking yourself, wow, are there other tax traps we will face in retirement? Well, the rest of what we'll cover isn't like what we've seen with the Social Security tax torpedo or the Medicare IRMA cliff. The public generally isn't aware of those tax squeezes. What we're going to see now is how the tax code in plain view snags retirees, especially when there's no planning. And that brings us to our third key. You must plan how and when you will use taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. You can't be haphazard about tapping your tax-deferred savings. Timing is everything, and if you don't plan carefully through all stages of retirement, you'll encounter unintended tax consequences. Let's take a look by first addressing a question I hear often when doing retirement planning: which accounts to spend first? Here's a common example: Sam and Mary. They have been good savers, as you can see, and are looking forward to spending their retirement years traveling and seeing their grandchildren. In addition to Social Security benefits, they have $450,000 each in an IRA, $60,000 each in a Roth IRA, $300,000 in a joint bank account. They want to spend about $8,500 per month, or just over $100,000 per year. Where would you take money from first? Most people think first take the after-tax money in the bank, then take the tax-deferred IRA money, and then take the tax-free Roth IRA money. This is conventional wisdom. It has been promoted by many big investment firms for some time. It's not a bad plan, but we know conventional wisdom isn't always the best approach. Not surprisingly, this topic has drawn the attention of academic researchers specializing in financial planning. They've conducted multiple studies on how to prepare for retirement using a combination of Social Security, taxable bank accounts, tax-deferred accounts like IRAs and pensions, and tax-exempt Roth accounts. You can see some study titles there. Their research has shown that the conventional wisdom approach probably isn't ideal. Here, in an alternative approach, there are two key elements in the early years. First, use the taxable bank money for expenses, but also during the same period, accelerate IRA distributions during otherwise low-income years, putting that money into Roth accounts. This is the filling your tax bracket approach, which we'll discuss in a second. This alternative approach gives you more flexibility to use that tax-free Roth money strategically in future years. Does it make a big difference? I think so. In the academic studies, this approach has been shown to increase portfolio longevity, that is how long your portfolio assets will last, without requiring you to take on additional risk. The big takeaway here, of course, is that you've got to plan all the way through retirement, especially around how you handle your tax-deferred assets. And of course, see your tax professional for tax advice. One way to help manage your income both before and during retirement is to utilize Roth IRA conversions. A Roth IRA conversion is a simple process that allows you to move money from an IRA or other pre-tax retirement account like a 401k to a Roth IRA. In general, the amount that you convert is added to your income for the year and will be taxed at your rate. For example, if Jill converts $100,000 from her IRA to a Roth IRA, she will have to add $100,000 to her income. The conversion income will be taxed at Jill's rate. For that reason, it's recommended that prior to making any conversion, you consult with your tax professional. A conversion doesn't need to be all or nothing, though. One helpful conversion approach is called filling up the bracket. Often, you may find yourself in the middle of one of the tax brackets with room to add more income without pushing yourself into a higher bracket. For example, in 2024, the 22% tax bracket for married couples filing a joint return goes from about $94,301 to about $201,050. If you file a joint return and your taxable income is $110,000, that means that you could add another $90,000 of income without going into the next bracket. Making a Roth IRA conversion like that could make sense. If you plan to convert a large IRA, this approach is often more tax efficient than converting the full amount in 1 year. Instead, you can make smaller Roth IRA conversions over a number of years, filling up your bracket each time. This can help reduce the average tax rate you'll pay on your converted money and also spreads the tax bill out over a longer period. Roth IRA conversions can be especially powerful in years when your taxable income is low, such as having a high non-recurring medical expense deduction or a low sales year for a business owner. It's also common for people who retire early and are not yet receiving Social Security benefits, pensions, or IRA distributions. They may have a very low tax bracket, making it a good time to complete Roth IRA conversions in those pre-RMD gap years. So this is a good time to spell out the crux of things. You must know whether you're trying to keep income below a bracket threshold to avoid bumping up to the next highest tax rate, or whether you're trying to increase income to fill up a bracket to take advantage of that tax rate. Some tactics you could use in managing income around tax brackets might include withdrawing tax-free money from life insurance policies to keep income low, selling highly appreciated stock for low or no capital gains, taking distributions from IRAs or 401ks to take advantage of a lower tax rate, and, as we've seen, you can also consider partial Roth conversions to fill up lower tax brackets. There are also 2 other pre-retirement strategies to consider, but they don't apply to all people. The first has to do with how you use a health savings account. This would only apply to people who are covered by a high deductible health plan, HDHP. The second has to do with small business owners. Those who want to be extra tax savvy in saving for retirement can fund a company pension plan, which for certain high-earning business owners can increase their ability to claim the qualified business income, QBI deduction. Both of these features of the tax code could be used to manage your tax exposure and provide significant tax-favored benefits throughout retirement. If either or both of these apply to you, go ahead and note that now on the questions area of your evaluation form, and we can discuss it later. We've seen throughout our presentation the critical importance of managing our tax-deferred accounts, because at some point, you'll be forced to take out required minimum distributions, or RMDs, and that can be troublesome to your tax bill. But many people make charitable donations supporting their favorite nonprofit with annual gifts. So let's look at how your RMDs and charitable giving may work for you with some planning. Meet Albert and Shirley, who are in the 24% tax bracket. Now, the standard deduction for a married couple filing a joint return in 2024 is $29,200. But Albert and Shirley are over 65, so they each get an additional standard deduction, bringing their total standard deduction for 2024 to roughly $32,300. This means they will receive no tax benefit for any itemized deduction unless their total exceeds that $32,300 mark. So, If Albert and Shirley have $15,000 of existing itemized deductions, say from state and local taxes, deductible medical expenses, and mortgage interest, what happens tax-wise if they donate $5,000 to charity? They get no federal income tax benefit from making the charitable contribution because it doesn't exceed their $32,350 standard deduction. That's not to say they shouldn't do it, but they should understand it's not helping them save on taxes. Now, if you're over 70 and a half and have an IRA or inherited IRA, there's another way to give to charity than simply writing a check. It's called a qualified charitable distribution, or QCD for short. Let me explain how it works so you can see why a QCD can be so powerful. First, some rules. If you are 70 and a half or older, you can make a qualified charitable contribution of up to $100,000 each year from your IRA. If you're married, and both of you are 70 and a half or older, and both of you have an IRA, you can each make up to $100,000 qualified charitable contribution from your own IRA. Second, any qualified charitable distributions you make counts towards satisfying your required minimum distribution for the year. However, when you make the distribution from your IRA, it must go directly from your IRA to a qualified charity, or you can receive a check from your IRA custodian made payable to the charity. Third, this is the odd part. Even though you gave to charity, you get no income tax deduction. So, why would I suggest a strategy where you get no deduction for giving to charity? Because when you make a qualified charitable distribution, the distribution from the IRA is never counted as income when you compute your taxes. Let's see how that helps Albert and Shirley. First, let's suppose Albert and Shirley do what many retirees would do. Albert takes his required minimum distribution of $5,000 at the beginning of the year and deposits it into the bank. He's done with his RMD for the year. Now, being charitable people, they donate $5,000 to charity. The end result is that the charity gets $5,000. Everybody understands that, right? But let's look more closely. By virtue of giving to charity this way, Albert and Shirley's $5,000 charitable contribution will cost them a total of $6,200. Why? Because the $5,000 RMD that went into Albert's checking account at the beginning of the year still has a tax cost. Remember, the couple is in the 24% tax bracket, and 24% times $5,000 equals $1,200. So, the $1,200 of additional tax that Albert and Shirley must pay when they file their taxes means the total cost of their charitable gift is $5,000 plus $1,200, or $6,200. Remember, the gift didn't impact their standard deduction. The RMD behind the gift just added to their income. Ouch. Now let's see what happens if Albert and Shirley use the QCD to give the $5,000 to charity. Instead of requesting a $5,000 distribution from his IRA to go into his bank account, Albert would simply have his IRA custodian transfer the $5,000 RMD directly from his IRA to the charity. That satisfies Albert's yearly RMD because he is over 73. Now the charity is in the same position as before. They receive a $5,000 donation. A good day. Albert and Shirley, however, are in a better position. They still give $5,000 to charity. Even though they receive no deduction for making a contribution, their IRA distribution is excluded from their tax return. Therefore, they owe no income tax on the $5,000 distribution. Their total cost to give the $5,000 to charity is $5,000, a $1,200 savings over our previous example, simply by knowing how to use the tax rules to their advantage. And they did it all without ever getting a deduction. But we all know charity starts at home. So it's a natural question to ask, how does retirement tax planning figure in? It's a very good question, because the government still wants its share of those tax-deferred assets when you pass away. And like we've seen, how you set things up really matters, which leads us to our final key number 4. Organize your assets for your family's benefit. Estate planning still matters. Estate planning is always a relevant topic, even though people don't like to discuss death. But we're not going to discuss it in the traditional way. That's because the new tax law excludes estates valued at up to $13.61 million from the federal estate tax, meaning only the tiniest fraction of people need to worry about estate taxes. Note, you may still face an estate or inheritance tax at your state level. Still, very important tax issues remain around how your assets are received by your beneficiaries after you die. One example is making sure married couples plan for their available step-up in basis. That's quite a tax term, right? Simply put, a step-up in basis is a tax rule that readjusts the value of an inherited asset so its value is not what your spouse or descendant paid for it initially. Instead, it's stepped up to its price on the date of death. This can make a big tax difference, as we'll see. It's likely that most assets you own, other than your retirement accounts and annuities, will be eligible for a step up in basis. Let's consider Phil and Mary, who live in a separate property state. They're married and own a variety of taxable investments in a joint account known as joint tenants with rights of survivorship. And the investments have long-term capital gains of $120,000. One day, bad news arrives. Phil is diagnosed with terminal cancer. He has 18 months to live. Let's see how this works with two scenarios. In the first, Phil and Mary make no planning changes to their assets. When Phil dies, Mary will receive a step up in basis on Phil's half of the joint account, which is $60,000. She'll still face a future $60,000 of unrealized gain on her half of the account. Simply put, that means if Mary decides to sell all the assets, she'll owe tax on her $60,000 of gain. Now suppose that upon Phil's diagnosis, Mary and Phil moved all the investments into one account in Phil's name. Then, as long as Phil lived longer than 1 year, Mary would receive a full step up in basis on the entire $120,000 account. Simply put, Mary could sell that account and pay no tax. When you sell your investments, would you rather owe tax on $60,000 of gain or none? And let me say, planning around death is hard, but this is where a professional can help because they are emotionally removed from the situation and can assist you to make good decisions that may seem hard at the time. Now, maybe you're someone who has managed to save up quite a bit in your IRA or 401k. You feel pretty confident that you'll be comfortable in retirement and are hopeful that you will leave behind the account to your children. In the past, we'd have recommended that because with the right structure, your heir could withdraw the money throughout his lifetime, possibly decades. That changed with the passage of the Secure Act in December of 2019. Now, beneficiaries of inherited accounts, with some exceptions, must withdraw all of the money within 10 years of the owner's death and pay taxes on that money. This restriction on what was called stretch IRAs shines a light on how important tax planning is. Laws can change at any time, so you need to have a plan and revisit that plan regularly. Let's look at Pamela and Kyle as an example of what choices beneficiaries have when they inherit IRAs and no longer can stretch distributions over their lifetime. The first scenario we have involves Pamela and her son Kyle. Pamela unfortunately passes away at 70 years of age, leaving the full IRA to her son Kyle. He is an only child, is healthy, and the sole beneficiary of the IRA. We know that Kyle has a maximum of 10 years to withdraw the IRA monies to meet the required minimum distribution rules. Kyle likes regular distributions, so he chooses to take equal distributions of the funds over 10 years. The IRA earns an average 6% rate of return annually. This payment would calculate to be $54,347 to Kyle each year for 10 years. Kyle would have to add this amount as income on his tax return for 10 years. The second scenario for Kyle looks a little different. Kyle lost track of time, and he has already reached year 10 of the required minimum distribution window. Since it is year 10, he must now take out the full distribution in 1 year. Assuming the same 6% rate of return is earned annually on the $400,000 IRA, we can calculate the IRA balance has grown to $716,339. Kyle must take the full $716,339 as a distribution in year 10 and pay income tax on that amount. Kyle will likely be in the top tax bracket in year 10. Okay, enough about death. Let's talk about long-term care. This is not a long-term care presentation. It's about retirement and taxes. But believe it or not, there are a number of tax breaks associated with long-term care insurance. For example, long-term care premiums may be a deductible medical expense at the federal level and possibly eligible for deductions or credits at the state tax level. And on the other side, if you are receiving long-term care benefits, in many cases those benefits are tax-free. For instance, benefits received from reimbursement-style policies are tax-free. In addition, cash benefit-style policies are tax-free if they don't exceed the higher of your actual long-term care costs, or an IRS daily limit, currently $410. Choosing how you pay for long-term care costs can have a big impact on your estate and your heirs. In recent years, non-traditional long-term care policies that blend together some long-term care insurance and life insurance have become popular. Often, the first inclination of the insured here is to tap the policy to pay for long-term care costs, but that's often a tax mistake. Let's take a look at Florence, a widowed woman who qualifies for long-term care benefits and lives at home with in-home care. Her yearly care costs are $60,000. Florence's Social Security benefit is $20,000 annually, which covers her basic expenses, but not long-term care. She also has $400,000 in an IRA and a life insurance policy with a long-term care rider that will pay $500,000 to Florence's children upon her death. Alternatively, Florence could use up to $10,000 per month for long-term care costs. Any amounts used for long-term care will reduce the life insurance death benefit. Please note, this is just an example and is not meant to represent any specific policy, but many long-term life insurance hybrid policies work this way. First, suppose Florence is infirmed for 5 years and uses her policy to pay for long-term care expenses. That's why she bought it, right? Here, Florence pays little to no income tax during this period because she'll have such large unreimbursed medical expense deductions. The $500,000 policy pays out $300,000 to $60,000 per year for 5 years. That means her kids will inherit tax-free life insurance of $200,000, the remainder of the $500,000 policy value. In addition, her children will receive the $400,000 in her IRA, which will be taxable to them. Now, let's suppose Florence lives for the same 5 years, but uses her IRA money to pay for the long-term care expenses instead. Florence still pays minimal income tax per year because of her high medical expense deduction. And now, the kids will inherit the $500,000 of life insurance completely tax-free, as well as roughly $100,000 of remaining IRA money which will be taxable. Comparing the scenarios, the ultimate net benefit is unknown because it depends on Florence's children's tax rates. But it's hard to imagine a scenario where paying for her care with $300,000 of taxable money, with minimal cost to Florence, is not a better option than paying for her care with $300,000 of tax-free money. In the second scenario, we're preserving the tax-free money for the heirs and paying for the long-term care with Florence's taxable IRA money. Okay, we're toward the end and you're probably thinking, goodness, how in the world will we ever manage this? It's a good question. Let's bring it all together. We started with a clear statement about the problem. Retirees often pay more taxes than expected because a confusing system treats various income types differently and contains hidden taxes and penalties. So let's do a quick review of what we've learned in the context of the 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of your retirement savings before you retire. And we also saw that in those pre-retirement years, it's critical to consider your tax-deferred savings and start taking advantage of funding Roth accounts to fill your brackets, something you do through your early retirement years in low-tax years. We also looked at Social Security and taxes, plus the importance of couples having a benefit strategy that considers the surviving spouse. And we saw Medicare has its own tax-like structure that can push you off the IRMAA cliff. And we saw the importance of signing up for Medicare on time, right in the middle of those early go-go years. That's because starting in your middle retirement years, you'll be confronted with required distributions, and we've seen the importance of planning your income needs before then and the tax issues involved. And then we saw the importance of setting up your assets and managing them during the later years of retirement so that you can preserve the most for your heirs and leave them with the most tax flexibility. All those items together lead us to this obvious solution to our original problem. Because your tax exposure will change throughout retirement, you need a strategy that anticipates how and when you tap assets to cover your personal expenses, understands the range of taxes you will face at various stages, manages your actions so you pay the lowest tax rate possible. By watching this presentation, you're indicating that you're preparing to leave the accumulation phase, saving for retirement, and moving to the distribution phase when you start spending retirement assets. We've seen that the distribution phase is more complicated than working and collecting a paycheck. Managing your tax rate through the 4 stages of retirement is part of the challenge of retirement planning. We've seen the cost of mistakes. Naturally, we want to be efficient with our savings, and there are strategies to reduce your tax burden. But as with many things in life, this takes education, planning, and advice. It's a lot to think about. Our tax code is complex, and the rules keep changing. But what doesn't change is that you need a plan. Thank you again for watching. If you have any follow-up questions, please do not hesitate to reach out to me directly. Our office number and my email are on the slide. As always, we appreciate your time and hope we answered some questions for you. Tune in next month for the next video in our financial planning webinar series. Thank you.